Hey friends, my name is Sahil and this is my Personal Finance Academy. Now that we are in the final quarter of the financial year, one of the priorities is income tax planning. I'm sure nobody wants to pay a huge amount of income tax. So there are multiple options to reduce your tax liabilities. For example, under Section 80C, you can reduce your income tax up to 1.5 lakh. Now there are multiple options to reduce your tax under Section 80C. For example, you have PPF, that is Public Provident Fund, NSC, that is National Savings Certificate, Life Insurance, Tax Saving FD, NPS, that is National Pension Scheme, and so on. But my personal favorite is ELSS, that is Equity Linked Savings Scheme. So it is a type of mutual fund that help you reduce your taxable income up to Rs 1.5 lakh under Section 80C. Apart from this, there are multiple ways to save tax under Section 80CCD, 80D, 80E, and so on. Now in this video, I don't want to discuss all these options to save tax. I want to discuss a very interesting technique of tax harvesting where you can legally reduce your income tax on both stocks and mutual fund. This is a relatively newer concept and I'm sure many of you would not be aware of it. So if you want to save tax on stocks and mutual fund, then watch this video till the end. By the way, let me know if you want to create a video on various ways to save income tax. I've already covered the top 3 LSS mutual fund to save tax. You can find the link on the top right corner. And before we proceed, I want to aware every one of you regarding the fake channels on Telegram and Instagram where the fraudsters have created a profile with my name and photo and scamming people by sending messages for investment in crypto and other paid services. And there are multiple accounts on both Telegram and Instagram. In fact, one of the Telegram channel has 9,300 subscribers. To confirm the identity, my Telegram channel link is t.me/Sahil Bhadviya, whereas the fake channel name is t.me/Sahil Bhadviya Real. So please be aware of such scams. I never share investment advice personally. In case you want to follow me on other platforms, then you can get the official link from the description box on my YouTube videos or directly from my official website. And in case you have followed the fake channel, then please unsubscribe yourself. Alright, coming back to today's video, I have divided this in 4 parts. In the first part, we will quickly discuss the taxation on stocks. Then, in the second part, we will discuss the taxation on mutual fund. And then, in third part, we will discuss how to save tax on stocks and mutual funds using this technique of tax harvesting. Then, in the fourth part, we will discuss the key points to keep in mind before using this tax harvesting technique. Alright, let's get started. So, taxation on both stocks and mutual fund is divided into 2 categories. Short-term capital gain and long-term capital gain. Let's first discuss the taxation on stocks. So if you sell your stock investment within 1 year of purchase, your profits will fall under short-term capital gain. And there's a flat 15% tax on profits under short-term capital gain. For example, if you have invested Rs 1 lakh and your investment value has become 1.5 lakh within 1 year, and let's say you sold your investment, then you will make a profit of Rs 50,000. Now you have to pay a tax of 15% on this profit of Rs 50,000. That is, Rs 7,500 would be your tax. Very simple. Now if you sell your stock investment after 1 year, then your profits would fall under long-term capital gains. In that case, you have to pay a tax of 10% on profits. But the good news is that there is no tax on profits up to Rs 1 lakh. So let's say you invested Rs 1 lakh and after 1 year, your investment value becomes Rs 1.5 lakh and you sell your investment. Now you will make a profit of Rs 50,000. But there is no tax on this amount as this amount falls under Rs 1 lakh. So let's take another case. Let's say you invested Rs 5 lakh and after 1 year, your investment value becomes Rs 8 lakh and you sell your investment. Now you will make a profit of Rs 3 lakh. Now you don't need to pay any tax on this initial 1 lakh profit. So if you exclude that, you need to pay tax on this remaining 2 lakh profit and that would be flat 10% tax. So you will end up paying Rs 20,000 as tax on your total profit of Rs 3 lakh. I hope it is clear. Now there are 2 categories of mutual funds, equity oriented mutual fund and debt oriented mutual funds. If you invest in equity oriented mutual fund, then taxation would be exactly same as stock investment. So if you sell your equity mutual fund within 1 year, then you will have to pay flat 15% tax, and if you sell your equity mutual fund after 1 year, then you will have to pay a flat tax of 10% on profit above Rs 1 lakh. However, it is a bit tricky with debt mutual funds. Here short-term capital gain is considered for a period of 3 years. So if you sell your debt mutual fund investment within 3 years, then it falls under short-term capital gain. And if you sell your debt mutual fund after 3 years, then it falls under long-term capital gain. Now for short-term gain, the taxation on debt mutual fund would be as per your income tax slab. So if you fall under 30% tax bracket, then you will have to pay 30% tax. If you fall under 20% tax bracket, then you need to pay 20% tax, and likewise. I hope you are clear with tax on short-term capital gain on debt mutual fund. If you sell your debt mutual fund after 3 years, then it would fall under your long-term capital gain and taxation would be 20% tax with indexation benefit. Now this indexation benefit is a bit tricky as it considers the cost inflation index, that is CII. I don't want to get into the details of this calculation, but for simplicity, just understand that the longer you hold your debt mutual fund investment, the higher would be your indexation benefit. So effective tax would fall somewhere between 15 to 18% depending upon the indexation benefit. Remember, you need to hold your investment for at least 3 years to qualify for long-term capital gain benefit in debt mutual fund. In case you are thinking about taxation on hybrid mutual fund or balanced mutual fund category that invest in both equity and debt, then in that case, if the mutual fund has more than 65% allocation in stocks, then taxation would be similar to equity mutual fund. And if the hybrid mutual fund has less than 65% allocation in stock, then taxation would be similar to debt mutual fund. Alright, now let's look at the concept of tax harvesting. You remember we discussed only the profits in both stocks and mutual fund example, but what about the losses? We will discuss it in this section of tax harvesting. First of all, what exactly is tax harvesting? So there are two types of tax harvesting. One is tax harvesting on short-term capital gain and another is tax harvesting on long-term capital gain. Let's first understand tax harvesting for short-term capital gain. Let's say you bought some stocks in the current year of FY 21-22 and out of that you sold some stocks in the same year to book profit. Now let's say you invested in 10 stocks and out of that you sold 6 stocks that were giving good return and generated a profit of rupees 1 lakh. Since it is a short-term capital gain, you need to pay a flat 15% tax on this profit of rupees 1 lakh. That would be rupees 15,000. This is the tax you have to pay to the government. Now how can you avoid paying this tax? So what you can do is, let's say out of 10 stocks you invested, 3 stocks are in loss and total loss is rupees 40,000. So you can sell those stocks to book loss and repurchase them again immediately. This way you will book a loss of rupees 40,000. Now earlier your profits were rupees 1 lakh and after the loss booking of rupees 40,000 your profits would reduce to rupees 60,000. So you need to pay 15% tax on this 60,000 now and that would be rupees 9,000. So you will save rupees 6,000 on tax with this tax harvesting for short-term capital gain. And this amount would vary from person to person. The higher the profit and losses, the higher would be your tax saving. For example, if you have made a total profit of rupees 5 lakh in a year by selling stocks, then you will have to pay a tax of rupees 75,000. Now if you also have a few stocks giving a loss of let's say rupees 2 lakh and if you sell them and repurchase them, then you will book a loss of rupees 2 lakh and your total profit would reduce to rupees 3 lakh. So your effective tax would be rupees 45,000. In this case, you will save rupees 30,000. I hope now you understand the tax harvesting for short-term capital gain. We generally don't sell mutual funds in short term, so I'm not taking a mutual fund example. But you can do the same thing with mutual funds as well. Now let's look at the tax harvesting for long-term capital gain. So let's say you invested rupees 5 lakh in stocks and after 1 year, your investment value is rupees 8 lakh. Now here, you don't have to pay any tax if your profits are up to rupees 1 lakh if your stocks have completed 1 year. So what you can do is identify stocks that have completed 1 year and sell them in a way that your profits do not cross the limit of rupees 1 lakh and you can repurchase them again. So from total profit of rupees 3 lakh, you will sell stocks with profit up to rupees 1 lakh and save 100% tax on them. This you can repeat every year to save up to rupees 10,000 per year on long-term capital gain. This same technique would also work on equity mutual fund. You can sell your equity mutual fund investment that has completed 1 year. For example, let's say you invest rupees 3 lakh in mutual fund and you have generated a profit of rupees 4.5 lakh. Then you can sell mutual fund in a way that your total profit booking is up to rupees 1 lakh and then immediately repurchase them. This way, you will save tax up to rupees 10,000 per year on equity mutual fund. I hope you are clear on tax harvesting for long-term capital gain. Here, you don't have to book losses. You have to book profit up to rupees 1 lakh to save tax, as there is no tax on profit up to rupees 1 lakh in long-term capital gain. Now let's discuss the key points you need to keep in mind before you use this tax harvesting technique. First of all, tax harvesting only works on realized profits and losses. It doesn't work on unrealized profits and losses. So unless you sell your stocks and mutual funds, you don't have to pay any tax. And if you want to take advantage of tax harvesting, you need to sell your stocks and mutual funds to realize the profits and losses. Second, please note that when you sell your stocks and mutual funds, the sell is in FIFO, that is FIFO mode. It means first in, first out. So let's say you purchase 10 stocks of a company at rupees 500 and then again repurchase 5 stocks of the same company for rupees 600. So you will have a total of 15 stocks at an average buy of rupees 533. Out of 15 stocks, if you sell 12 stocks, then you will end up selling your 10 stocks from rupees 500 and 2 stocks from rupees 600, as 10 stocks at rupees 500 were bought first. So that's FIFO, that is first in and first out. This works in the same way with your mutual fund NAV as well. Third, please note that if your losses are more than profits and you book losses, you can offset your losses against the profit booking for the next 8 assessment years. Fourth, you might think, what is the right time to do tax harvesting? So there is no fixed time. You can do tax harvesting anytime during the financial year. So from now, you have time till 31st March to plan your tax harvesting. Now, fifth question can be that, will tax harvesting impact your compounding? Now, this is important. When you book profit on stock and mutual fund and repurchase them, your returns would reset. For example, let's say you invested in IRCTC at rupees 300 and made a profit of 200% by selling at rupees 900 for tax harvesting. Now, when you repurchase IRCTC, you will end up buying at rupees 900 and on the trading platform, it would not show 200% return. So from compounding perspective, there won't be any impact, but it is just that you won't see that 200% return in your trading app. So you will lose out on that feel good factor by seeing those 200% return as you have booked the profit to save tax. Now at the end of the day, you need to take a call on whether you want to save rupees 10,000 per year by tax harvesting for long-term capital gain, or you want to see those good returns in your trading app. Otherwise, tax harvesting for short-term capital gain is certainly a great way to book losses and reduce your short-term capital gain. So in this video, we discussed about the taxation rules on stocks and mutual funds. Then we discussed about the tax harvesting for short-term capital gain and tax harvesting for long-term capital gain. I hope now you clearly understand how to save tax with tax harvesting technique. Then we also discussed the key points to keep in mind before doing this tax harvesting. By the way, if you are using apps like Zerodha, then you can directly see your long-term capital gain and losses and short-term capital gain and losses to identify how much tax you can save with tax harvesting. If you find this video useful, then please share it with your friends and colleagues. And if you have any doubts, let me know in the comments. In case you want to learn everything about tax planning, mutual funds, stock fundamental analysis, you can explore my course on money management. I'll see you in next video. Till then, take care.